All right, here's a sim on the FASB framework. How important is the FASB framework? Well, when they give you your score on the CPA exam, it's one of the major categories when they show you how you did. Here's how you did on the FASB framework. So pretty important, even though it's all about vocabulary and terminology. So let's answer true or false with regard to the FASB framework. Number one, the objective of general purpose financial reporting is to provide information about the entity useful to current and future investors and creditors. And that's true. That is the objective of general purpose financial reporting, to provide information about the entity useful to current and future investors and creditors in making decisions as financial statement users. And what kind of decisions are they going to make? Well, maybe they already invested in this company. They want to know if they should buy more stock, if they should sell the stock, if they should hold on to it. And maybe they're a creditor. Maybe they're a bank that loaned money to the entity. Should they renew the loan or maybe call the loan due? Number two, there are two primary characteristics of useful financial information: relevance and reliability. And that's false. While there are two primary characteristics of useful financial information, they are relevance and faithful representation. Correct, not reliability. Reliability is not a substitute for the term faithful representation. So you got to know your terminology really well in this FASB framework. Because like I said, this is one area where they're going to tell you how you did on this part of the exam. They're not going to tell you how you did on leases or how you did on bonds or how you did on non-monetary exchanges or even consolidations. But they're going to say, here's how you did on the FASB framework. So you got to know your way around the FASB framework. And there's two primary characteristics of useful financial information: relevance and faithful representation. What this means is that for information to be useful, it must be both relevant and faithfully depicted. Now, here's what the FAR exam expects you to know about the terms relevance and faithful representation. We'll start with relevance. We said these are the two primary characteristics of useful financial information. Relevance, in order to be relevant, the information must contain predictive value, confirming value, and it must be materiality. It must be material information. So relevance, you got to know the ingredients of relevance, which are predictive value, confirming value, and materiality. Then the other primary characteristic, faithful representation. Well, in order to be faithfully represented, the financial information must be complete. It also needs to be neutral, without management bias, and free from error. Number three, completeness, neutrality, and freedom from error relate to the relevance of financial information. True or false? False. Look again. Right. Completeness, neutrality, and freedom from error relate to faithful representation, not to relevance. And that's what they're going to do when they test you on the FASB framework. They're going to play one against the other. So you're not only going to have to know the two primary characteristics of relevance and faithful representation, but you're also going to have to know the ingredients, the components of each one. And the components of faithful representation are completeness, neutrality, and freedom from error. The components of relevance: predictive value, confirming value, and materiality. Number four, to be relevant, information must be material and have predictive value and confirming value. That is true. To be relevant, information must have predictive value, confirming value, and be material. That's true. To be relevant, information must have predictive value, confirming value, and be material. Predictive value is used to predict future outcomes, such as future cash flows. Confirming value provides information about evaluations previously made. And materiality, information is material if its omission or if its misstatement would affect the decision made by the users of the information. So to be relevant, you've got to connect relevance with predictive value, confirming value, and materiality. Number five, to be faithfully represented, information must be without bias and must have predictive and confirming value. Oh, be careful with that one. No, that's false, right? To be faithfully represented, information must be without bias. That part's right. but it has to be complete and without error. Nothing to do with predictive value and confirming value, because those terms go with relevance, not with faithful representation. So make sure that you can play this one against the other game. Practice it, because that's what the exam is going to do. Number 6, completeness is an ingredient of faithful representation. And that's certainly true. Information is complete only if it includes all the data necessary to be faithfully represented. Good, so number 6 is true. Let's go on to number 7. Predictive value is an ingredient of faithful representation. True or false? And that's false. According to the FASB framework, predictive value is an ingredient of relevance, not faithful representation. So far, we know that the primary characteristics of useful financial information are relevance and faithful representation, and we know that within relevance are the ingredients predictive value, confirming value, and materiality. Within faithful representation are the components completeness, neutrality, and freedom from error. Number 8, with regard to faithful representation, neutrality requires that contingent losses, if they are probable and estimable, be recognized in the financial statements regardless of any possible effect on the company. And that is indeed true. Firms are reluctant to report losses, but for information to be faithfully represented, neutrality requires that contingent losses, if they're probable and estimable, be recognized in the financial statements regardless of any possible effect on the company. You know what this means. If there's a contingent loss, possibly the company's being sued, and management feels that it's probable and estimable that they're going to lose, they know the amount, they can estimate it at least. Well, according to neutrality, this loss should be booked with a debit to loss and a credit to a liability in order to have a faithfully depicted financial presentation. Management doesn't want to book the loss, but they're not allowed to use that as a reason for saying, well, maybe we're not going to lose, so maybe we shouldn't book the loss. No, we know that if it's probable and estimable, then it needs to be booked in order to have faithful representation. Management needs to be neutral with regard to the determining whether it's probable and estimable. Number 9, the pervasive use of accounting estimates for pension expense, depreciation expense, bad debt expense, rather than actual figures is an example of emphasizing relevance over faithful representation. And that is true, because sometimes relevance and faithful representation will conflict. The pervasive use of accounting estimates, using estimates for things like pension expense, depreciation expense, bad debt expense, warranty expense, many expenses are estimated under GAAP rules. And using those estimates rather than actual figures, that's an example of emphasizing relevance over faithful representation. Reasonable estimates are preferred by financial statement users in order to receive information before it's too late to make a difference. And it's considered better than no information at all, even though the estimates cannot be perfectly reliable. So while both relevance and faithful representation are the primary characteristics of useful financial information, sometimes we have to pick one over the other, and in this case we're choosing relevance over faithful representation. Number 10, the use of historical cost as a valuation base for assets on the balance sheet is an example of using faithful representation over relevance. And that is true. Historical cost, what you spent to purchase an asset such as land, that's based on past information that's easily determinable and it will not change. Therefore, it's faithfully represented. But this historical cost figure is often not particularly relevant to financial statement users compared to market value. Yet we still use historical cost to value assets like land. That's an example of choosing faithful representation over relevance. Remember we said sometimes the two will conflict, and sometimes we choose one over the other. So in the last two questions, this one and the one before, we saw a conflict between relevance and faithful representation. In number 10 here, we chose faithful representation over relevance. Back in number 9, we chose relevance over faithful representation. Let's look at 9 again. 9 says the pervasive use of accounting estimates for pension expense, depreciation, bad debt expense, the estimates rather than the actual figures. That's an example of emphasizing relevance over faithful representation. And that's true because we do use estimates in GAAP. So 9 and 10 were good examples of where faithful representation and relevance might conflict. So here's what we have done so far. The primary characteristics of useful financial information, relevance, and faithful representation, and the components of each one. Okay, now we're moving from the 2 primary qualitative characteristics to the 4 enhancing qualitative characteristics of useful financial information. You've got to know that under the FASB framework, there are 4 enhancing qualitative characteristics of useful financial information, and they are verifiability, comparability, understandability, and timeliness. True or false? And the answer is true. There are 4 enhancing qualitative characteristics of useful financial information, and they are verifiability, comparability, understandability, and timeliness. And you can remember that a V-cut can be very enhancing. All right, these are the enhancing qualitative characteristics. V, C, U, T. A V-cut can be very enhancing. And here's a little example of how enhancing the right V-cut can be. So we got to get familiar with V-cut now because we need to know verifiability from comparability. We need to know understandability from timeliness and how they can enhance the qualitative characteristics of relevance and faithful representation. Because what V-cut is designed to do is to enhance relevance and faithful representation. And how are they going to ask you about that on the exam? Let's go to number 12. Well, for starters, you might get something that looks like this. Number 12, verifiability, comparability, and completeness are 3 of the 4 enhancing qualitative characteristics of useful financial information. Are those 3 of the 4? Well, V-cut only has 1 C, doesn't have 2 C's. Verifiability, comparability, understandability, and timeliness. That's V-cut. What's completeness doing in there? Completeness is an ingredient of faithful representation. And faithful representation is a primary, not enhancing, characteristic of useful financial information. So back to the 4 enhancing qualitative characteristics. The 4 enhancing include V-cut, verifiability, comparability, understandability, and timeliness.